Gold hit 3,000 last night. Not sure if you guys saw that, but we did in fact see gold for the first time ever trade above $3,000 an ounce. Very cool. Historic stuff. I mean, that is a huge move for gold here. Recently, but just in the last few years. I mean, gold has kept up with, the returns of the stock market, which is really impressive. You got to think, I mean, it's been a period of time where stocks have been phenomenal. And meanwhile, gold has actually done very well too. Here's going back from here's 2016 to now. If you've just sat holding gold during that time, like 2016, you bought some gold, you're looking at 155% return on investment on a super boring, stable metal. It's crazy. Now, the downside to gold is that it doesn't yield anything. If you buy certain stocks, they offer you dividends, so you get paid just to hold them. But who really cares when gold is moving like this, right? You got gold moving like that. Who cares you're getting dividends if the thing is just going up and up and up? I don't think it'll go up forever, but recently, we've been very bullish on the show on gold. Stand with the trade here. I did trail my stop loss yesterday. Took my stop from down at 28.25. I've moved it since up to the just below the lows of yesterday's price action, right? So pretty much started out yesterday and just exploded higher. Gold was able to break that 4-hour chart level of resistance that we kept talking about. You can see there it is, right? So we broke that resistance right here and no pullbacks, right? This can be very frustrating at times for the break and retest traders like myself. I mean, from a technical perspective, that is typically how I like to enter a trade. Technically I did enter this trade from a break and retest. It was just on the daily chart, right? So this breakout retest, I went in on this and continue to hold the trade. I mean, for me, gold looks very attractive. On my system, the Edge Finder here, we've still got a very bullish reading, a +10 score, very strong reading overall. That's telling me that most of my factors here, economic data, technical reads, sentiment reads, are pointing bullish for gold at this time. So I continue to really like the setup. I do think gold can keep going. A lot of times people will see a big move like this, and man, how many times have I repeated that on stream? A lot of people think when gold makes a big move, oh, it's got to come back down now. It's gone too far. It's stretched. It's overbought, right? Just to watch it do what it has done for the last several years. You could have pointed to a million different times where gold looked overbought. Meanwhile, it's having one of the best runs that we've had in decades, right? I mean, gold has not made this kind of move since back in the great financial crisis, pandemonium, right? That's the last time we got, I mean, this is sharper than that in some ways. Gold is absolutely ripping. Again, that's probably, in my time trading, the best performance I've ever seen for gold has been in the recent, 2-year period or so. Well, couple year period, going back to the pandemic, right? We had the pandemic sell off, every kind of assets across the board sold off, you can see, but gold recovered it very aggressively. Continues to be one of my favorite things, both long-term and short-term. Gold is one of my favorite things to trade, but also to hold long-term. That being said, for me, long-term, gold is probably not as attractive at this time. But if you get a larger pullback, metals can have ugly drawdowns and pullbacks just like everything else. Even in this up trajectory for gold, we've seen pullbacks. There's a 9% pullback. In 2022, you had a pretty good sized pullback with the inflation stuff, right? So from peak to trough here, you had a 22% pullback in the price of gold. Going back from here, was it any worse? Yeah, about 22%. So at 22% pullback, that's still better than the stock market. During that time, stock market was down about 28% peak to trough. So gold has just had really impressive performance. Again, the shiny metal just keeps winning overall. That being said, doesn't mean that it's impenetrable to selling and pullbacks and things like that. But for me personally, like I said, I've been long on gold here for the last week and a half or so. My stop is below that kind of big shoot to the upside that we saw yesterday. So if we come back and fail at this area, in fact, I actually may look to, if we get a nice closure today, I'm probably going to just go ahead and move my stop up just behind this market structure here, the previous all-time high, 29.50 or so. But I mean, this morning we were trading the 3,000s. We may do a little bit of a 3,000 pullback continuation. That would be my opinion. Just because something is overbought does not mean that it cannot get more overbought, right? But I wouldn't be surprised if we saw gold do one of these guys, pullback and continuation.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
But I think indices have upside from here. I don't think that this is going to be a major market crash. And that's what the headlines will have you see. That's what the market sentiment will have you see right now. People are terrified. We've been talking about this on stream days after days after days. And I have been more recently pretty aggressively buying the dip. My portfolio is pretty much flat on the year. Oh my gosh. Oh my gosh. The put to call ratio. This put to call ratio is going to make me go buy more stocks. Look, everybody's terrified of the stock market right now. Not only that, here's your evidence. Put to call ratio just jumped to 1.03. People are buying puts and they're paying massive premium to buy those puts. People are scared. People are convinced the market's going to crash. Everybody is. The crowd mentality is market crash. It's happening right now. Look at the AAII Investor Sentiment Survey. We got this yesterday. This is 3 back-to-back weeks where investors are somewhere around 60% of investors responding that they feel bearish on the stock market. I mean, look, that doesn't guarantee that's going back up either, because technically sentiment has been kind of decreasing or getting more bearish in recent weeks. But I think we're crescendoing here. I personally, I really do think that we are closer to a bottom here than many people think. So we added some features here recently. First of all, we color-coded latest data in orange. So if you have recent last 7 days, if something came in the last 7 days, it now populates in your Edge Finder as a yellow text item. It means that it came in recently. Now for the fun stuff. We recently, as of yesterday, have added the US dollar and stocks impact. And by the way, we will have all of these things up to speed for the remainder of our heat maps. Man, I'm so excited about this. So if I'm looking at the US dollar impact, right, of this recent data, most of these things are not looking great for the US dollar. But what about for stocks? They're not exactly evenly, right? So, or they're not exactly the same, right? So US impact, US dollar impact is not the same as the stock market impact always. Like for example, inflation data, right? Inflation data came in cool. That's not good for the dollar, but it's great for stocks, right? Cooling inflation is what the stock market wants to see. It means the Fed can cut rates. So that's not good for dollar, but it's great for stocks. And, you know, working with so many traders, we have, like I said, we have traders all over the world that have questions, that have concerns, that, you know, use our tools. One of the big questions that we regularly get is, you know, inflation, how does it impact stocks? How does it impact dollar? How does it impact gold? And we're trying to build tools and resources that will automatically showcase that to you and make it easier to understand for the average trader. So, like I said, overall, when people are saying like, oh, the stock market's going to crash, look, I don't see that, right? In the data, I'm not seeing that. We're getting overall a mixed view for stocks. It's a bearish view for the dollar, but we don't see massive, like if this was like 40%, or I'm sorry, if this was like 30% or 20% of these things are bullish, like most of these things are just straight up red for the stock market, then maybe it would be a little bit different. But you've got a lot of stuff holding up decently. Like recently, jobless claims came in slightly better than expected. JOLTS job openings came in better than expected. That's good for stocks. But also inflation this week was a win. Inflation was a win for stocks this week because you had cool inflation. Services PMI came in better than expected. And, that's the point. The point is, if you want to say we're on the brink of a recession, the data's not really showing that. Is it saying we're in a rock star perfect economy? No. But you just kind of have to say, look, we're somewhere in the middle, but what is the market trading like? The market's trading like we're going off of a bridge, right? That's what the market's saying. The data's not saying that. And that is where trading opportunities are born. See how you're holding up in this market.
That's exactly what it is. I'm holding up. It's fine. I mean, I'm still hanging in there. Today's a good P&L day, but watching carefully. Got a couple trades on this morning for SPX. Listened to some good podcast stuff last night, and just wanted to share a couple thoughts and views on things. So, technically speaking, we've had a decent flush to the downside. Everyone knows that. I don't know if the pain is necessarily over with. I still think that a sign of a potential bottom, not only technically of having this kind of fib from like high to low, but also looking at market breadth here, Nick. If you go to this little, where the heck is it? My little S&P above the 50-day moving average and the Qs above the 50-day moving average. They're somewhere in here. There it is. What? There it is. Okay, this one. So S&P stocks above the 50-day moving average. This was a pretty good and has been a pretty good timing indicator of market breadth offering up kind of a massive opportunity. Mm-hmm. It's not there yet. So if we see more pain to the downside, this would be something I'd be watching for a buying opportunity. We come back into, the lows in January. You look back here, timing this thing, Nick, when we had lows in what? October 2023, was that not the bottom?
Yeah, you're right.
Best time to buy after August, September pullback was October 2023.
So Chris, what you're looking at here is basically for the novices, the new people out there, the number of stocks or the ratio of stocks that are above or below their 50-day moving average created into an index on TradingView. You guys could grab that and add that to your watch list as well.
Yep.
But yeah, so when you're saying when that gets to an extreme low, when everything is kind of correlated, everything is selling off universally, you get that capitulation, that flush. That has actually been a good signal of potential reversals here. Is that what you're saying?
Yes. So, and just look at these levels. So this was January, and it wasn't, I wasn't overly bullish going into the first part of the year. We had that like kind of holiday roller coaster from Fed and then back up, and then the Santa rally failed. In early January, the market kind of picked up, but not really. But just look left and you find some better levels. If you bought anything back in October 2023, great timing on that. That was right after an August-September correction, and from October 2023 into all of pretty much 2024 until April, you had a pretty good surge, and obviously 2024 is still a pretty good bull market, climbing the wall worry. Before that, a nasty bear market through most of 2022, and you still had a June and an October window, which, June would have dealt with one more flush to the downside, but October, coming out of that Q3, Q4 transition in 2022, that was also what got us out of the bear market. Mag 7 led the way, tech started to lead the way, and it seems so long ago. The market's up 70+% since those lows. But look back even further, March 2020. What was that? The bottom in COVID. Okay, before that, 2019, Volmageddon after 2018 December's crash. So all I'm saying is, if there's more pain to the downside, Nick, this is a good indicator to have the courage to say, okay, I think I could still take a stab at the market and be rewarded for that. So that's
yeah, Chris, I wanted to ask you about that, just in general, about how you're seeing playing this market. And just to follow up, I asked you a little bit of how you're holding up. I mean, guys and girls out there, if you are anything near positive on the year right now, you are dramatically outperforming passive holding. I mean, I wanted to show you this. This is me so far here this year. I'm pretty much flat on the year, but it's in a context of, here's the NASDAQ, right? So NASDAQ is down about 9% with the bounce back here today. So I'm trying to hold up a beat, but this is the reason I brought this up is because prior to 2025, right, when everybody was getting just absolutely euphoric about, markets and Trump 2.0, and there was a period of time where on the show, Chris, you and I were talking about how it's reasonable to keep a cash position. It's reasonable to diversify. And listen, diversification absolutely stinks when the market's just going straight up. But then you're very thankful for it when something comes along like this, where we get the tariff trauma and the fears about what could this do and what could we go into a recession, all this. I just wanted to kind of reflect on that with you for a second about just the power of diversification, options in your case, right, where you're selling premium, and this kind of environment gives you some potential great opportunities. I've been selling a lot of puts on stuff, but just wanted to get your thoughts on that. And if you feel, because it sounded like you're talking about looking to deploy a little bit more as this market gets uglier, what's your approach to this, and what's your thoughts on that diversification theory?
Yeah, well, trading through and diversifying through are the only way you're going to survive this. I do want to call out some big levels. Here's what concerns me. Okay, I think this administration, it kind of had way too much excitement going into the election bump and into the first part of the year, thinking that this is going to be just straight up tax cuts and straight up great for business. It's not. Like right now, this chainsawing the federal government, this Doge agenda and tariffs and retaliations, it's like, if this continues to escalate, it's going to force the Fed to possibly be what has to step in and kind of reassure the markets that, hey, the Fed's there to still be accommodative and dovish, maybe more monetary policy, because what people are looking past right now is, I don't think Trump nor current investors realize how important the fiscal policy was the last 4 years. That's really what's been carrying a Fed that's been raising rates and pausing and being more restrictive on monetary policy in order to tame inflation. So point is, if the market's going to crash in, like, let's say on Trump's watch over the first 6 months of his presidency, or whatever this year looks like, it does set the bar extremely low for, look what we did. Biden's administration was terrible. We had so much inflation. Nobody's happy. I mean, he can get away with so many things to say how bad it was, even though the market's crashing right now on him. He doesn't have to take responsibility for it. But if the bar is set really low, then the fiscal side can come back in along with a dovish Fed, and they can fix it. Does that make sense? So we could go from like a 10-12% correction. And I don't think this is as bad as it gets. I mean, if you're seeing my chart here, my biggest concern, Nick, is that we're not done. And the best we're going to get right now is like a little relief rally towards maybe the 200 moving average, or maybe slightly higher. But we have a high-low recovery and then another flush down. And that, to me, is an open space. And that open space opens up the doors for previous resistance back in 2021, 2022 when the market topped out. That's talking more like 20+% correction. And here's what I don't want to do. I don't want to be overextended in this window of uncertainty, because if we don't have a reasonable rally to kind of de-risk like I talked about this week, I need to make sure that I'm playing some heavy amounts of defense to the downside. So I hate to say it, but I'm not super bullish right now. I'd be pleasantly surprised to see the market get back into sniffing out those all-time highs again, because it shows that the bulls have maybe grabbed the upper hand a little bit, as opposed to a dead cat bounce and the market flushes down and there's more pain ahead. Because that pain ahead of a 12, 13, 15% correction in the S&P could equal 20+% in the Qs. If we're in open space, there's no reason the S&P can't be 20%. There's no reason the Qs can't be 25 to 30%. And we're having a very different conversation when not just are you surviving, but it's like, how's everybody doing? Are you, stopping trading? It's like, I'm going to trade through it. I'm going to diversify through it. But like I said, my biggest window right now is if I have the opportunity in the near term to de-risk, I'm going to de-risk. A lot of my trades are still mechanical. They're all probability based anyway, but I don't want to see, stupid losses. I don't want to see like the pain trade of like, okay, man, you're up $3,000. Like I'm showing today, I'm up like 17 grand for the year. I was up $195,000 like 2 weeks ago.
Yep.
So
It can move fast, man. And that's
Yeah.
the thing is I got to hop off here and run, but I just wanted to get your thoughts on that and see where you're at with it. But yeah, one thing you mentioned there, I agree with the 200-day moving average. If you get that pull back into it, let's see how market reacts to that 200-day. Is there kind of to sell that immediately, or can we recapture that and trend higher? That 200-day is a decision point. When we took out that low and we closed below it, man, it's just been a flush since then. So are we close to a low, Kenza? Do you think we have the potential to start bouncing back, or is this not over?
Yeah, I think we are on the lowest areas comparing to the previous sell-offs. But I think there is still a room maybe for a continuation of that downtrend. But for now, yes, the market might try to reverse, but it's better to wait for the market to cross. You see, the last support that we have, or let's say now it's going to be the resistance. If we cross that red line, that yes, if we cross that, I can say, yeah, maybe it's promising that we might see the market going up, because there are so much stuff going on. Plus, with the tariffs and other things, it seems like earnings seasons might be very bad for Mega 7 or for these big tech companies. So that can continue to sell off. But for now, I think, yeah, the market did breathe very nice. I think maybe it's time for it to bounce back, but there is still a lot to think about.
Kenzo, can I give you a quick pitch on why I think this market is due to go higher? Can I give you my couple things that I've been thinking about?
Yes, yes.
Just show this to you and to the audience. This is a little preview of my video I'm working on today. I know this is a little hard to read, but a couple things that I think are actually quite bullish about this market right now. First of all, sentiment is extremely skewed in terms of the bears. So what I mean by that is that if we go over here and we just take a quick look at what the crowd is thinking. First of all, the put to call ratio just went parabolic. So everybody on the options market is buying puts. They're buying protection. They're buying insurance. They're terrified of where the market is going next. People are convinced the stock market's going to crash. That's what the crowd, that's what the herd is thinking right now. At the same time, take a look at the AAII Investor Sentiment Survey. This shows you what investors report on their kind of feelings about the market. And what we can see here is we hit for the first time, by the way, check this out, Kenzo. This is the first time that we've had 3 consecutive readings this extreme since 2008 in the financial crisis. That is how scared people are. People are reporting, feeling very, very bearish on this market. So to me, sentiment is extremely, extremely one-sided. Everybody thinks the market's going to crash, at least the vast majority. At the same time, a lot of people think that the recession is in, that we're going to have a huge fallout in the economy. But the bond market is saying, no, because the bond market is saying yields have not, in a recession, right? What happens in a recession? Yields plummet as the bond market says, oh my gosh, we've got a disaster. In 2018, people were seriously fearful about a recession. And you see, that's what the bond market does in that time. Yields completely drop off of a cliff. So the other thing is that, just going off of sentiment as well, the VIX has gone parabolic to the upside once more, showing that everybody, like I said, is pricing in, thinking that there's going to be huge volatility and huge drops to come. And then we had good inflation data this week. And then the last thing that I'll mention, and I want to hear your thoughts on all this, I know I'm throwing a lot at you, is that if we look at the economic heat map, which we talk about regularly together, most of these indicators, we added a new feature, the stocks impact feature, or the US dollar impact feature. And then we summarized it at the bottom to keep it easier for our users. And what you can see here is that we have a mixed report for stocks. Now, that doesn't mean that the stock market has to go up or down. It was a mixed report, means it's mixed. So if everybody thinks it's going to crash, but the data is actually kind of mixed for stocks, there's a divergence. So that's what I wanted to share with you. What are your thoughts on all that?
Yeah, I can say there is enough possibility for the market to reverse, because I think when we have bad news in the market, let's say the tariffs and stuff like that, mostly the market will sell off. And on the news, it seems like to be a actually bad news, because we already saw the sell-offs. But if we check it on the other side, it was necessary for the market to sell, and
Yes.
there is enough reasons to say the market might go up. If we checked previous, let's say 4 economic events that we received, mostly they were cooling off, which means inflation is not really as crazy as we thought, and which means we expect indices to perform very well with the lower inflation. And yeah, I think the panic is going to be there, but when we check events, fundamentals, everything supports that reversal. Because if we check the real reason why maybe we saw the sell off, it's not like maybe there is a bigger company like maybe Nvidia not performing very well. It's just the panic from the tariffs, panic from other external things, which they don't really have. Actually, they have a direct impact, but it's not like 100% direct impact that can affect those mega companies. Yes, there will be price increase here and there, but the performance will still be there. And I think the business will just go as usual, because tariffs now, it's just getting popular, but tariffs, they've been there for a very long time. So I think yes, there is still that room. Now the market might still struggle around that level. There is that still a room to reverse, but I think it's better to wait a little bit.
For a technical perspective too, Kenzo, another thing that I've been watching is the 200-day moving average, which there it is. For the NASDAQ, for the S&P 500, we've lost some key technical levels. And to your point earlier about, the technical trend still looks pretty rough. Sellers kind of taking control of this market, at least for now. What I think we need to see from a trader's perspective would be a recapture of this area that you discussed here, but also a recapture of this 200-day moving average. That to me would give me more confidence that this is not a massive bear market push that's just not going to stop. I think actually if you start to see some solid footing forming at these levels, things could look really good for the market. But like I said, I think everybody is convinced that the stock market's going to crash, that's going to go to zero. So we may have some bursts of downside movements. And I like what you said there too about, certain companies are poised to be in better situations than others. Like Amazon and Google, these companies are names that I've actually been adding to my portfolio pretty recently. So I'm adding some long-term positioning in stocks that I like in this sell-off. So very curious to see where that goes. What doesn't look so good, and what actually might be another helpful agent for all this, Kenzo, is the dollar index, which has been weak recently. We go back to the heat map for just a moment. You can actually see that very few things are bullish for the US dollar. We have a very low score here, which indicates a lot of bearishness. When we look at this list of things, most of this, especially this week with inflation data coming in very, very soft, giving us more bearish confirmation, it's the dollar index may, in my opinion, continue to be in a bearish trend for some time. Now, why that also is meaningful is that if the dollar continues to trend down and inflation continues to cool off, that could mean that the Fed does in fact cut interest rates, which ultimately could also be a bullish thing for stocks as well. What do you think on that?
Yes, I think you are 100% right there, because remember, the thing that makes maybe the market to go crazy, there might not really be the real effect on the markets, because like now when we say tariffs, we just cover everything. But if we check nicely, Trump, I think it's last year, he said actually the dollar is very strong and he wants to make it weaker. And I like the fact that on DXY we start to see that dollar is getting weaker, which means all those like inflation, slowly they're going to go down. There were like government spending, reducing government spending, that will also deflate the dollar. So which means at the end of the day, we are going to see the rapid decrease on the inflation side. And that it's actually a very good thing. It means we might have maybe some rate cuts going maybe around June or going up there, and which is good. The problem is when investors listen to the news, they don't really care what's really happening. As long as maybe it's a breaking news, we tend to use that information to everything. But actually, it doesn't really relate exactly to the stocks. Like now, when we say the Microsoft is selling, what's really going on? Is there anything bad? Actually, no. Everything's actually performing very well. But if we checked for the week, everything was just going down. Why? Because we have this ripple effect from this breaking news, tariffs, Russia, whatever. But when we check nice, everything is actually at the level where we can say it's time to buy. If you check those stocks, let's say Tesla, Microsoft, Apple, they are on the lowest areas, maybe 12 months lower, which means it's actually a good time for us to look for those. You actually be buying at the discounted price. And mostly that's what investors want. Unfortunately, at the moment, it's like we are on the panic mode. But when we check, if we can leave the politics aside, I think everything looks good. We are supposed to look for those bullish moves.
Yeah, very, very interesting. And again, the other one we could mention is oil prices lower. Sorry for the chart delays here. I'm not sure what's going on. I don't know if it's me or if TradingView's got some weird delays in it right now, but having some issues loading certain charts. So I can still hear Kenzo and see Kenzo. So I imagine I don't think it's my internet, but anybody in the chat, is anybody seeing, anybody having issues with their TradingView, or is this just me? Okay, I think we're back. I think we're okay. Consumer sentiment just came in light, 57.9 compared to the forecast at 63.1. Previous was 64.7. So seeing some consistent drop here in the U of Michigan. Consumer sentiment reports, inflation expectations at 4.9%. So very interesting. We are seeing a little bit of concern come into the charts here. Taking a look at the S&P 500, NASDAQ blipped lower here. We'll see if they stay one way or the other. Dollar index not too changed here, and gold slightly positive on that data point. So,
did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.